right, ladies and gentlemen, I think we might, just to get you up and running, if we can get the poll up, we've got a little bit of trivia to get the afternoon session, get the mind going. I know it's getting towards the end of the day, but some interesting stuff here. There was a great article on Visual Capitalist. If you don't follow that website, definitely worth checking out. But there was some incredible work done on the companies that have generated the most shareholder value in the past 100 years. So keen to find out which of the companies up there do you think has generated the most shareholder value? And I'll put it to the no cheat notes. Jacob, Mary or Nick will be asking you. This should be bread and butter for you guys. We'll get some responses up there and then we'll get in and have a look. Right, before I tell the answers, Nick, what's your call?
I think it's NVIDIA or Amazon.
Jacob?
Microsoft.
Mary?
Apple.
What is it?
Apple.
Well, luckily we have a lady on the stage. The brain's up front. So Apple has generated $2.7 trillion in shareholder value since it was listed. It's absolutely, I think it accounts for nearly 5% of the returns. But Warren didn't do too bad. He was number 6 on the list, and Microsoft was number 2. So we had some amazing returns from those companies. I think the interesting thing to know is that of the 28,000 publicly listed US companies analysed over the past century, the 25 best stocks have created nearly a third of all the shareholder wealth. And it talks to the topic of the panel today, which is really about, how do we identify the winners? We want to find the ones that are going to deliver those huge returns. But in global markets, there's so much hype and so much energy put into it. So which ones are overhyped and which ones are underrated? What we might do is just get a quick test of the temperature around the grounds in terms of where people are, what they're hearing from the companies. And then we're going to take a dive into the Magnificent Seven and some of the other big themes that we're talking about in markets, energy transition. So Nick, I'll start with you. What are you hearing from companies when you're out there visiting companies, hearing their reports? What is generally the mood from the companies that you're investing in?
Yeah, thanks, James. I can maybe just tell you one story. So we've done a lot of travelling this year. We're Melbourne-based manager, so it's good to be allowed to leave Melbourne again. It's very helpful. And I was in Seattle in June. In fact, I was just telling Jacob the story. I was in Seattle in June and I was seeing Microsoft, and I sort of said to them, I said, is this AI stuff real? I mean, you guys are going all in here, or are you just trying to distract us from the macro? Because the macro is pretty bad. And the story they told us, and I think Bobby summed this up before, is that effectively, when ChatGPT came out, Microsoft, after roughly $1 billion invested in ChatGPT, and had $1 billion in about 10 other different things. And Satya Nadella dragged the entire workforce of all the senior managers of Microsoft inside, and he said, look, when ChatGPT came out, they never realized how well it would work, and it worked incredibly well over December. A lot of people saw it. And so Wesley said, this company missed the mobile revolution. We missed the whole mobile revolution. We became number 1 in the world in the PC revolution, missed the mobile revolution. We're not going to miss the AI revolution. And so they effectively went all in on AI with Copilot products. They've increased their CapEx by $15 billion. And that's flowed all the way through the system. If Microsoft goes, Amazon goes. If Amazon goes, Google has to go. And all these semiconductor companies start to perform accordingly. So the big thing that shifted this year for us is there is, a secular story in AI, and then a couple of other secular stories out there that I'm sure will flesh out, that are ultimately getting people to look past the macro, getting them to see across the valley to the other side. And you've seen that with AI and the Big Seven, but you also see it in things like the energy transition. So we're talking a lot less macro than we used to, say, this time last year.
Jacob, I'll take it to you. Hard landing, soft landing, no landing. Is there any evidence of where we're headed from the companies that you're speaking to at Antipodes?
So the survey data, and leading data, it's very weak. And then if you take it to retail sales in the US, they're only up a couple of % year on year. So that means the real volumes are going backwards. Services have held up much better than, let's call it, goods consumption, but services are catching down. Anecdotally, though, there's a gambling boom taking place, whether you're in Vegas or Macau. In the case of Vegas, room rates are 40% above their 2019 levels, and Macau's reopening really, really strongly. And Look, generally it's in the results. If you think about the coincident data, like the data that the company managements are seeing, it's actually holding up. And I think that's because of savings. Savings. Bank of America retail deposit is roughly, the average retail deposit is roughly 20% above its pre-COVID level. So there's still healthy savings. And then if you go through the economies that are really well positioned for a weaker inflation outcome, it really is emerging markets like Brazil. Interest rates in Brazil are 13%. Inflation is 3%. You think we have it tough? Think about that dynamic. And that other emerging market, the UK, we do think, inflation will come a lot weaker. And look, it's looking for equities which are priced for a hard landing, as opposed to trying to be the genius to pick the hard landing or soft landing. It's actually, how's it priced? I think that's,
Mary, anything you want to add on that front in terms of what you're hearing and seeing on the ground before we jump into some more specifics around the Magnificent Seven?
Yes, I think it depends where in the world you are and which management teams you're talking to. So I agree with Jacob's point. For the US economy, I'm in the soft landing camp. But outside of the US, if I was on a trip to China a few months ago, that is probably hard landing already. And those meetings are quite negative, especially if you're with old economy companies or property companies. Brazil, Mexico, India, absolutely booming. And then within other developed economies, UK is very weak. Germany is, likely to go into technical recession, but Japan is experiencing some of the best macro conditions we've seen in decades. So what management teams are telling you, it really depends on where you are.
Well, I'm going to bring up the first chart for our session, which shows an equal weighted performance of the Magnificent Seven, which for those of you that aren't up on the acronyms, which I'm sure you most all, but it's Apple, Microsoft, Alphabet, Amazon, Nvidia, Tesla, and Meta platforms, which is Facebook. And as you can see, there's a massive divergence in the performance there. Mary, I'll stay with you. What's the problem, or is there a problem that gets created? I mean, have you been surprised by this concentration of strength?
I think the first important thing to highlight about the Mag 7 is it's not just a technical phenomenon. It's not just that these are 7 big stocks and everybody crowded into them and that's why they went up. You've seen so far this year, all 7 of them are in an earnings upgrade cycle. And for some of the former FANG mans, these are very, very big earnings upgrade cycles. So there is some fundamental drivers behind that. And then you've also had, this whole AI as a tailwind. I think the problems going forward, though, are that there is significant concentration. So that's both an opportunity and a risk for fund managers. The opportunity is if you stock pick correctly within those 7, you can generate a lot of alpha. So for example, we have no position in Apple, which is maybe why I got the first question right. We have no position in Apple. And for the last few weeks, not holding that has been very alpha generative. So that's a big opportunity for fund managers. I think one of the other implications has to do with regulation. So we've already seen NASDAQ look at that chart and become worried and say, okay, we're going to do a rebalance to take those 7 down. And also from a more business perspective in the US, you've seen the regulators, there's an antitrust suit coming out with Google and there's an antitrust suit on the card for Amazon. So whether these 7 can continue to dominate the business structure in the US is a question mark.
Nick, I know the way you invest, you actually love finding the concentration. You love finding those few winners. Does this create a headache for an equity manager, or is this a healthy thing that we're seeing just a few stocks drive the markets higher?
The slide here really quickly if I can. If you just pull up like these, one slide, this back one. Yeah, I think it's important to understand, look, I know this is happening, but there is a really big fundamental tailwind behind it. As I said before, the AI issue is effectively your iPhone moment for this generation. And so if you think about the iPhone when it came along, and I think Bobby summed this up really well before, when the iPhone came along, it put the internet on your telephone. The internet got on your telephone and suddenly that was great, but it really was the millions of apps that created the ecosystem. It was the apps that followed your fitness, the app that helped James get a date or find his wife, etc., etc. And on it goes. And this is what the app, sure. That's what the app ecosystem did. Large language models are exactly the same thing, okay? So Bobby just gave you 2 examples of how you're going to use a large language model to help AI, or use these large language models for AI to solve problems, okay? There are going to be millions of these. This is your iPhone moment. And so if you just go to the next slide really quickly, The reason why this is happening with these stocks, because across the top, you are starting this next technology super cycle, okay? It's started. Microsoft kicked it off. And you're going to have millions and millions of people try to build apps that run off AI or run off these large language models. That's what you've got at the top there. Bobby just mentioned two. They're all going to use these large language models, and everyone's going to try and build these large language models. But he said something really important. He said that all has to run on the cloud. You can't get it to run without it running on the cloud. And the cloud is owned by 4 companies. The cloud is owned by Microsoft, Google, Amazon, and if you're being generous, Oracle. And then all of them have to double their capex to take all this new capacity, and all of that capex ends up going to NVIDIA. And so from that point of view, you are getting, and I think Mary summed it up, you are getting these fundamental earnings upgrades. You know, the cloud, usage of the cloud is accelerating much, much sooner than we thought it would. And it's accelerating because of this AI boom. And capex for the cloud providers is accelerating much, much sooner than we thought it would. And it's all going to NVIDIA. And so just to put this in perspective, like NVIDIA has upgraded their earnings this year by more than 300%. People thought they'd earn $5 next year. They're now going to earn nearly 20, okay? It's covered by 26 analysts around the world, you know, who are all getting paid a lot of money. It's the 7th biggest company on the planet, and it's upgraded its earnings by more than 300%, okay? So this is fundamental. This isn't just index. This is really happening because these companies are really at the epicenter of this big acceleration that Bobby just talked to you about, and that's why they're running. And so from our point of view, you know, you should definitely hold them. And if anything, it's all we should have held, quite frankly, because the other stuff hasn't done as well.
Jacob, I'll bring you in here. The issue of concentration, is it grabbing our attention when there are other opportunities elsewhere?
Oh, look, there's a lot to unpack there, but to carry forward what Mary referenced is, I think it's opportunity. There's a lot of dispersion amongst the 7. They're very different businesses. There's consumer facing, there's enterprise facing. Our preference is more for the enterprise facing companies. You know, it's the Microsofts, and because of the opportunity to really adopt functional AI tools and upsell them within their existing platform. So it's a very low-risk way of playing AI. And I think in consumer applications, it may be very hard to monetize AI. But the other, just to carry on what Nick was saying, all that CapEx actually goes to TSMC. So, that stock is available on 12 times. So I think it's, taking the pragmatic value lens, make that concentration work for you, right? Like if you, within that, look for the stocks that are arguably mispriced to that longer term opportunity. And you can go from Microsoft, you could go to some of the companies, outside, the other software companies that can do that, the ERP companies like SAP, Oracle. And then, look, if you think you do achieve a soft landing, the question you've got to ask, where is it mispriced? In the soft landing scenario, is Apple going to go from a $3 trillion company to a $3.5 trillion company? Are we going to adopt more iPhones? Are they going to be able to aggressively monetize AI to their consumer base? It's a big bet. It's a risky bet at a PE of 30 times. A soft landing, I'd prefer to be in counting that, NatWest, a great retail bank in the UK, that's giving you a 20% return to shareholders via dividends and buybacks. I think that's where you'll make more money.
Well, I feel like it's a good hopping off point into our next chart. So I sent this spreadsheet around to all of the panelists and took the Magnificent Seven, and I asked them to tell me what they think, whether the stock was overhyped or underrated. Being investors, they subbed out my word for underrated and said undervalued. That was their choosing, not mine. I just want to draw your attention to Apple, which we already described was the stock that has created the most shareholder value in the past 100 years. Warren Buffett, in his equities portfolio, owns 51% of his portfolio is in Apple, and all three of you think it's a sell. So why are you, Nick, why do you think Apple is overhyped? I want to talk about this because it's had such an incredible track record.
Yeah, so as growth investors, we're looking for acceleration. Businesses that could accelerate their revenue growth over time. I've just talked about NVIDIA, which we obviously hold and has accelerated dramatically. Apple makes most of its money out of the iPhone, and the iPhone is fully penetrated at this point in time. The rest of its money it makes from a services business that is a great business. But I also agree with Jacob that it's, heavily valued at sort of 25, 26 times earnings at this point in time. So it's an interesting point is that Apple's revenue actually hasn't grown for a couple of years now. Most of it's been coming from the bottom line, i.e. the service business taking mix and obviously buybacks, which they do aggressively. And so from our point of view, the company actually stopped growing a number of years ago. And so while it's a perfectly fine company to invest in, and I wouldn't put everyone off doing it, they're obviously a great company, it's probably one from yesterday and not one for tomorrow from our point of view.
Okay. Mary, do you want to add to that one?
Yeah, I agree. It's low growth of the earnings stories of all the Mag 7. It's the weakest earnings upgrade. It's actually starting to get small downgrades. The thing that I'll add is I think the reason it underperformed over the last week was because of this China ban on government officials and people who work at SOEs in China owning iPhones. That is very, very significant because Apple has sort of had this, special status in China where they don't get the critique and the issues that other foreign companies, particularly tech companies operating in China, have come under. And if that is a shot across the bow in terms of Apple getting embroiled in the broader tech war, the technological Cold War, I think that's a strong negative for Apple going forward.
Their theses on Apple there. We might take a trip down to Tesla, which is a slightly more controversial stock. We've heard people talk a lot about electric vehicles on the Australian Equity Panel. We've heard Tim talk a lot about that particular area. Mary, you don't think it's overhyped or undervalued? You've got a neither on it. Wasn't a term I was after. Maybe you could unpack that for me.
So I'm not sitting on the fence here. We do not have Tesla in the portfolio because of governance reasons. So I'm not looking at whether the earnings are over or underhyped. It's out because of governance. And some of you have probably seen the bumper sticker that's going around in the US on Teslas, and it says, "I bought this car before I knew Elon was crazy." And that's kind of how I feel about the stock. Like, I love the product. They are super impressive in terms of manufacturing. Their long-term optionality in terms of AI and the charging stations, it's all really impressive. But particularly during the Twitter time, and now with this controversy about the Ukraine and all of Elon's other businesses, and it's just too much from a governance perspective. And then also the CFO, who, for those of us who listen to the conference calls, he was always kind of the adult in the room for Tesla. He's resigned. So I really, there's massive amounts of key man risk in Tesla, and it's a key man who's very volatile. So that's why I put neither.
Okay. Jacob, I believe it must have been 2016, you pitched Tesla as a short at Livewire Live. Looks like you still don't like it.
We made money. We've made money on our Tesla short.
Everyone made money.
It's like how you trade your shorts. So we've got positive P&L, and that's particular short.
I'm just having a bit of fun. Tesla overhyped at the moment. What's the thesis there?
Look, it's amazing what Tesla have achieved, and we covered it when we realized, well, number one, the borrow costs went to about 40%. And so it became very crowded as usual. And also they got through let's call it the danger phase in the business, right? Which was getting to some sort of scale. They're coming up to, they're in the millions of units now, right? As opposed to under 1 million. And that's a massive achievement. But as you get larger, you have to succeed in the mass market. And you won't make the same sort of margins in the mass market as you do in the premium segment. And I think that's the challenge for the company right now. And whether they can monetize their ADAS solution, that's a big ask, right? I mean, in autos, getting your consumer base to pay for something that they're used to getting for free, that's a big ask. And so, I still think it's, from a valuation perspective, it's very much overhyped. When, you can buy an auto stock, the typical auto company trades on even those who have a transition plan, like Toyota, they basically trade at a book value.
We might pick one more before we move on to a new segment. Microsoft, there seems to be a consensus view there. Nick, do you want to talk me through your more thesis on Microsoft, why you think it represents such compelling value?
Yeah, so from our point of view in Microsoft, so just a lazy $2.5 trillion, trades on around 26, 27 times earnings probably today, forward earnings that is. So it's not a cheap stock, but it's only a little bit more expensive than Apple. Yet we think it's the most likely to monetize AI from here. Again, Bobby talked about Copilot products. Some of you have probably seen the Microsoft Copilot demos that are coming out. So think about your Teams meetings where it will record your Teams meeting and summarize it for you. Think about a Word document you could feed in and it'll read it and turn it into a PowerPoint presentation. Think about an Excel file that it can take all the data and turn it into graphs by typing words, not by using functions. So that's what Copilot's going to do. It's going to be a productivity tool, and Microsoft, with the largest installed base, has the best chance of monetizing this. They've already announced what they're going to charge for it. So it's going to be $30 a user per month. If you think that roughly 25% of the users of Microsoft products, of which there are around 500 million that pay, take it up, then you get sort of a 15% earnings upgrade from Microsoft over the next 3 to 5 years. That's really simple maths. Obviously, there'll be discounts on that. But from our point of view, we think they've got the best chance of monetizing AI at the software level, and they're also one of the largest cloud providers. They're one of those big four, so they win in both sides of AI, so that's why we still like it.
Okay. Mary or Jacob, anything to add to the Microsoft thesis before we move on?
Can't wait to get my Copilot.
Very good. All righty, we might move on to the energy transition, and there's a few different themes sort of mixed together here, but one observation has been that the transition to renewables has been much discussed and much hyped, but it's been quite hard to make money from it. Mary, why has it been so challenging when it offers so much promise, and we've talked about this energy transition being the biggest challenge facing us and the biggest opportunity?
I'll make 2 points. The first is I think there's a bit of a disconnect between the time frame of energy transition and the time frame under which most investors expect returns. So, for example, the energy transition is for many European countries and for a lot of companies is somewhere between now and 2030. For more developing countries, it's 2050, 2060. And for some companies, their net zero targets are 2050. But for us as investors, like I'm up in the middle of the night checking my alpha, what's happening, and we put out monthly reports. And for Alphinity, because we follow earnings leadership, we're looking at quarterly earnings. And I think that's why it's been disappointing to a lot of investors, because that 2030, 2050 story may be intact, but you're not seeing it in the earnings right now. And that's led to a lot of blow-ups. The second point I'll make, though, is that energy transition is not just about renewables. So renewables have been quite disappointing, wind, solar, other parts of renewables. But within the energy transition, there's renewables and there's also energy efficiency, which means just, using whatever energy source you're using more efficiently. Those stocks have actually performed very well. So we have a sustainable fund, and stocks like Train, stocks like Schneider, they have been very good performers. Train actually hit an all-time high very recently. So I think it's important to differentiate between the renewables and the energy and efficiency stocks and how they perform.
Jacob, have you got a view on this?
Yeah, look, I think the key issue is supply chains. Like you cannot scale to achieve the energy transition. You need to invest a couple of percentage points of GDP in renewables and in the grid, and you need to do it for the next couple of decades. Where do you find the electrical engineers, the lines people? If you go to Siemens, a stock we have a bit of history with, you can go to Siemens Energy, you can hire a wind turbine. Hopefully it will work when it gets delivered. But the waiting period is a long, long time. And they cannot, offshore wind is the closest solution to base load power in renewables. Offshore wind, to achieve just the currently announced policies by 2030, you would need to scale the production of offshore wind turbines by a factor of 7. That isn't going to happen, right? Unless we have a massive price signal. So where is that price signal coming from? It's coming in the US, it's coming from the Inflation Reduction Act, which obviously is not reducing inflation. It's rolling out renewables, and in a market where you will get, I think, a response, because a lot of the utilities are regulated asset base integrated utilities, so they don't take a price risk on the project. They get a regulated return on investment. So they'll pay whatever as long as they can deliver the power. And in the Midwest and in the South, you are getting really efficient renewable power, right? You don't even need the subsidies. So look, this is going to happen, but the key is to find a way to play it where, as those supply chains scale, you don't get caught out by execution risk.
Nick, how are you attacking this particular opportunity? It received, it was, a lot of attention. It was talked about over 2020, 2021, and it seemed to lose a bit of steam. The wind came out of its sails, so to speak. How are you tackling energy transition? What looks like the most attractive way for you to play that opportunity?
Yeah, so the first thing I'd say is, look, we definitely still think it's there, and we were definitely one of the people talking about it, and we're still talking about it today. If you think about it, you don't have to decarbonise the economy, you just have to attempt to decarbonise the economy. And that's what we are going to do, because every corporate on the planet is effectively setting a net zero target because their investors are demanding it. So, if you go to BHP, there's a sustainability report, you can pick it up. Every year they need to be reducing their emissions. Same thing at Starbucks, same thing at TSMC, same thing at Microsoft, etc. So there's $50 trillion going in, and that's $50 trillion of revenue to the companies that help enable that decarbonisation. The reason why people are having trouble with it, and I completely sympathise to a certain extent, is because it's not really like digitalisation. It's not winner takes most, okay? So this is a physical opportunity with supply chains and problems. It's not a digital opportunity where Netflix appears out of nowhere and suddenly everyone's watching Netflix because it's winner takes most. It's different. It's physical. I agree with Mary. We've had a lot more success with the energy efficiency names. It's actually the boring companies that are the most interesting climate champions. It's the companies that make insulation, the companies that do electrical equipment, the companies that do air conditioning. They're the companies when Lendlease says, we're not going to build another building that's not 6-star, and you will not find a single large corporate in Australia that won't move into a 6-star building. So just go to anyone who helps build 6-star buildings, and that's Kingspan down to Schneider, down to Train, etc. So energy efficiency has been much more successful. Renewables is much harder. The reason why is because all the capital's gone there, okay? All the capital's gone there, whether it's from the major oil companies and other areas, and it's too hard. It's right now just a little bit too hard over there. But so we still think the opportunity is there. There's lots of different ways of playing it. This is just like tech in 95. There's lots of things that sound exciting that aren't going to end up being that good. But out of it are going to come these great climate champions, and we're very much convinced of that.
Have you got a specific example that you want to call out as something that is your preferred play for it at the moment?
So right now, two companies. One I mentioned, Livewire Live at the start of the year, which is Constellation Energy, which is nuclear energy. I don't think you're going to build many more nukes, but existing nukes on the ground are very valuable. Constellation owns the largest fleet of wholesale nuclear energy in the United States. Okay, to give you an example, so when Microsoft's trying to get to net neutral, they have to buy power from Constellation, which they have done because they see it as renewable. And on top of that, they have to pay a premium for it. And that base load obviously becomes more and more valuable as more renewables come into the grid and things become more volatile. Second one I'd give you is Kingspan, based in Ireland. There you go, another Irish stock. They make high-end insulation panels. So when you build a gigafactory, all the panels that go around it are Kingspan panels. Why? Because they're fire resistant and they help keep the heat in. Every time you build a data center, you have to put Kingspan panels around it for the same reason. So those would be the two I'd point to.
We're going to take a quick change of tack, and we're going to move from some of the overhyped or the well-known opportunities. And Jacob, I'll start with you. What's the market overlooking? What are the underrated ideas that you're finding out there that aren't grabbing the headlines?
Yeah, well, I mean, you've got multiple dispersion in the market is really wide. So there's lots of things that I think, looking in less obvious parts of the market, early cyclicals, I mentioned NatWest. Let's think about energy, the other side of energy transition. You won't find a hydrocarbon and oil company in the world that's actually investing much. So there are some very good supply stories, i.e. industries that are not adding supply. So even in a tough environment, we would think there's a lot of downside protection on the oil price. And to the extent that you want to invest in a company that's doing the right thing, a company like Total Energies, I think is very well positioned for a combination of the energy transition and also an environment of just energy scarcity. And so we think there is value in some of that conventional energy space. Secondly, some of the financials that are banks that are in environments of high inflation, where that inflation is going to come down fast, where you're getting, you're buying very low retail quality retail franchises. I think it's playing a bit of a barbell approach where you take advantage of the negativity around the economy, but in resilient businesses that are cheap, and they're going to be the first to inflate as rates can come down. Now, they may not come down in the US because inflation stays sticky, but I do think they can come down in some of the other markets around the world.
Mary, to you, anything out there that you think is being overlooked or underrated in terms of opportunities beyond the ones we've highlighted today?
So is this the point where we're pitching the stock that we want to pitch?
Feel free to pitch us down. Feel free.
Okay, I'm going to pitch my top idea. So I like Ferrari. I think that the luxury sector had a very, very good few years, and now it's come off a little bit. But within that, I really like Ferrari. Ferrari's ticker is called RACE. So in the next 30 seconds, I'm going to give you the case for RACE. The case for RACE is, number one, this is not an auto stock. This is a luxury stock. It has some of the best margins in the whole world. It has 50% gross margins, 20% net margins, 40% ROE, and is growing at 25% this year. So to find stocks with that level of profitability and that level of growth is very rare. The second thing is it's a technological leader. We all know the F1 racing, they use that same technology in the cars that we buy, and it's a leader in hybrids, which a lot of people don't know. By 2026, the majority of Ferraris are going to be hybrids. And the third thing that I like is that, Ferrari as a brand, they are really in control of their income statement. So at Alphinity, we're looking for stocks that are in an earnings upgrade cycle. And sometimes companies don't have very much control over that, and so they can miss earnings, and then they have a big downgrade. Ferrari very, very, very closely monitors their supply, and the demand is very high. So since they listed in 2016, they've never had a big earnings downgrade cycle. It's a beautiful stock, bottom left to top right. And the last point I'll make is it's kind of a stock for all seasons. So we've talked a lot about soft landing, hard landing, AI, these big thematics. People are going to want to buy Ferraris almost no matter what happens, and that's one of the reasons why I like it.
I'd like to know who you're hanging out with.
I said like to buy a Ferrari, not will buy a Ferrari, but everybody likes the brand.
Nick, you got something as fast as a Ferrari for us?
Uber. No, seriously, it is. It's Uber. That's the stock I'm pitching. I just thought I'd get the segue there. So from our point of view, look, obviously we talked about the big guys. It's all been coming through earnings upgrades. I do think you need to own them because I think they are core to the ecosystem that we're building. But it's now time to start looking for the things that haven't moved yet. Last year, for those of you who are growth investings, it was a tough year. Interest rates went from 0 to 5. And we saw, as I think Bobby pointed out, that one of the 4 big great corrections we've had in growth equities. You can now go back through the rubble and find some really, really good stuff from our point of view. What's really interesting at the moment is not only can you find good stuff that's in the rubble, but their competition's disappeared because their competition was being funded by 0% interest rates and causing this, let's just chase for customers at all costs. There's a lot of companies that fit this bucket, things like Airbnb that I know was spoken about earlier. Things like even Netflix is obviously lost a lot of its competition. But the one I'll talk about today is Uber. Uber, is today, nearly 4 years after its IPO, is still below its IPO price. Yet its revenues are 3 times above where it was when it IPO'd. It is now GAAP profitable. So all these tech companies have got religion really quickly. We want GAAP profits, okay? And in 2 years' time, it'll be on about 25 times GAAP profits because it's incredibly profitable. This company somehow spends more on R&D than Tesla does. I'm not quite sure on what. They spend more on SG&A than a lot of companies we look at, and they're cutting costs dramatically. But most importantly, it's a platform. We know what platform businesses do. Every single person in this room uses Uber. You're probably using it quite a lot, and that platform has the ability to grow over time. It sticks with the younger consumers and ages up over time. Also, it gets into the airport, so you can't actually get a taxi from the airport even if you wanted to anymore.
We just need to work out how to get them in the bus lane.
Correct.
And so for the Sydney traffic.
So from that point of view, I would argue Uber is undiscovered. It's cheaper. It's the same price it was 4 years ago, and it's GAAP profitable and on its way to serious amounts of profits, and it's a great platform, so I'd point you towards Uber.
Alrighty, great. Now, Jacob, before I cut things off, was Total your idea, or you got something?
Can I go again?
Go very quickly. We've got a shocking prediction to come up, so we're going to wrap it up here.
Look, we've owned Oracle for a number of years, and in the software bubble, Oracle was very unfashionable. And there's two things that we noticed that were going on in the company. Number one, Larry was tending not to be as promotional as had been in the past, and it was focusing a bit more on actually just delivering good product to the customer base. So the Fusion suite of ERP, cloud-based ERP, hadn't been getting much focus, and that was driving 25% of profits, growing at 25% per annum. And the cloud adoption of ERP had lagged other, SaaS offerings because its back office wasn't getting prioritized. And so as you convert those customers from on-premise to, it's SaaS, you get a value uplift. Secondly, the database business wasn't collapsing, and the database business was giving them a really rich customer list to build their infrastructure as a service. Yes, it's a distant fourth in cloud infrastructure, but one that's growing the fastest today. And we think that's, it gives you a lot of comfort in their future growth. And then you put the AI wrap it up in the AI narrative, and
off you go.
Right.
Awesome. Well, ladies and gentlemen, could you please put your hands together for our panel? We're going to wrap that up there. Thank you.